The semiconductor sell-off, AI bubble or healthy correction. Over the past few days, semiconductor, memory, and AI chip stocks have taken quite a hit. Everyone's asking the same question. Is the beginning of the end of the AI bubble or just a natural correction after months of euphoria? Let's start with the news. Moonshot AI, one of the most advanced Chinese labs, has released an open source model called Kimi free. I've tested it myself and the performance is genuinely impressive. Industry observers rank it slightly below Fable 5, so we're talking about the top tier model here. But the real point isn't how good is Kimi free. The point is how it got there. Despite US restrictions on exporting advanced chips to China, there is a technical detail worth understanding here, because it's the key to the whole argument. When an AI model generates a response, GPU memory is used for two things. First, the model waits. The model itself is frozen knowledge. Two, the KV cache, a temporary scratchpad the model uses to remember everything it's written so far in the conversation, so it can stay coherent. The longer the conversation or the input document, the bigger this cache grows, and it's one of the most expensive bottlenecks in the large-scale AI inference. Moonshot introduced a proprietary mechanism called Kimi Delta Attention, which manages to preserve performance while drastically cutting KV cache usage in long context scenarios. It's an architecture different from turboquants, and regardless of whether China used distillation techniques on US models data, the point remains the same. China is proving it can do an enormous amount with fewer hardware resources. So will this shrink memory demand? Fair question. If Chinese models consume less memory per token, will global demand for RAM and NAND shrink? I don't think so. If anything, probably the opposite. It's the classic Jevons paradox. When the computational cost of AI drops, people don't just use the same AI more cheaply. They use a lot more of it. Lower cost per inference means more applications, more users, more total volume. So demand for inference, and with it ultimately demand for memory too, tends to amplify, not shrink. So the real risk isn't on the hardware memory side itself. The real risk, frontier lab margins. In my view, the labs building frontier models, OpenAI, Anthropic, Google, and similar players. Here's the reasoning. Chinese models today lag US labs only 6 to 12 months, yet they are offered for free open source at a fraction of the cost. That's a structurally bearish factor for anyone monetizing through very high margin APIs. If a near state-of-the-art model is available for free, why would a company pay huge sums for API access to a slightly better one? This dynamic risk, squeezing frontier labs margins, discouraging further venture capital rounds into these companies, fueling doubts about the sustainability of hyperscaler capex. And in fact, despite solid fundamentals in memory and NAND, the market is reacting more and more defensively to every new piece of news, even news that on closer look doesn't really change the long-term fundamentals. This behavior, I think, is a telling signal. It suggests a lot of operators are overextended in these positions, and when the market is that lopsidedly positioned, further downside can turn into a violent correction. Not because the fundamentals collapsed, but because so many are forced to head for the exit at the same time. Zooming out, one of the more striking dynamics right now is how the sell-off in the most crowded trades is triggering a deeper rethink of the entire AI narrative. What started as a technical pullback is turning into more structural questions. So number one, is hyperscaler capex sustainable? Number two, is open source competition intensifying too fast? Number three, is memory supply expanding enough to weigh on prices? Number four, will the returns on this massive capital spending actually live up to the hype? To be clear, this does not mean the AI opportunity is over. It means the market is becoming more selective, sorting out companies with genuine, lasting fundamentals from those that simply erode a wave of concentrated optimism. One more thing worth flagging before we get to specific names. Right now, the stock prices are highly correlated to a single variable, perception. Any news, event, or shift in market sentiment suggesting that AI infrastructure spending has peaked or is starting to decline can drag the stocks down sharply, even if the underlying fundamentals haven't actually changed yet. That's exactly why we are seeing such outsized reactions to tourists like Kimi Free. The market isn't just pricing today's number, it's pricing the trajectory of AI capex. So Micron and SanDisk, what I'm doing? Let me give you a concrete example with Micron, which is down about 20% from its June hikes. I'm not buying it. The long-term contract story is genuinely interesting. It confirms that demand for AI today is enormous, but that doesn't change the underlying nature of the business. Memory remains a cyclical sector, and I think it will stay that way. Sooner or later, these massive investments will slow down. The $1 million question is when. That's why I haven't bought Micron and currently hold no position in it. I would rather miss out on potential upside than hold something I don't think can outperform over the next few years. Same story with SanDisk. I do hold one position in the direct AI trade, just one. If you want to know which stock it is and at what levels I got in, I go into the details in my investor club on Discord. To sum up, Kimi Free doesn't lower memory demand, but it does rise the level of competition on frontier labs margins, and that's making the market a lot more nervous and defensive, probably more than the fundamentals justify in the short term. As always, this isn't a financial advice, just my personal read on the situation. If you enjoyed the video, hit like, subscribe to the channel, and I'll see you in the next one. Bye.